Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hey, welcome audience to Achieve Wealth podcast. This is where we look at operators around the countries and learn from them. And I really appreciate you being here just because you have 1,001 things to do, somewhere else. But listening to us or listening to me and this podcast gives me great pleasure to be with you all. So today I have a very nice guest and a well-known guest in the Bigger Pockets and outside of Bigger Pockets community as well. Today we have Ben Leybovich from Phoenix. Hey Ben, thanks for coming.
How are you? It's a pleasure to be with you. I do a lot of these podcasts, but I have fun every time.
Yeah, that's awesome. Yeah, we want to go a bit more into detail. So I'm sure you've gone into a great length in other podcasts as well, but there's a few things that we look for. I mean, I'm an operator. We would like to go into a lot more details into the numbers and the strategies and all that, just because we want to learn and my audience want to learn. And we listen to podcasts to learn, right? Because everybody's spending time to listen to each one of those podcasts, and there are thousands of those out there. But I think it's important that we learn from each other. Yeah, Ben has been almost investing in multifamily residential real estate for over a decade. And he has been numerous times featured in Bigger Pockets podcast. I've been following him since very early days when I started in single family, where I learned a lot of things from Bigger Pockets, right? And he has been featured on 3 different episodes in Bigger Pockets. He's also the creator of Cash Flow Freedom University and author of House Hacking. He and his partner, Sam Grooms, has been buying deals in Phoenix market. I think they closed on 98 units, and recently you closed on 130 units. Is that right?
117. It's 117. Last week we purchased.
117. Okay. So why not you tell us about yourself to our audience on aspects that I've missed out about introducing yourself?
Well, thank you again for inviting me. I appreciate it. I like doing these things. Who doesn't like to talk about yourself? Especially when you're so good looking like me and I get to see myself on Zoom and it's fantastic, right?
Awesome.
Sam's not showing up for this. He knows how it's going to go. I don't know. My story has been very kind of public through Bigger Pockets and elsewhere. Folks, my website, justaskbenwhy.com. My story is all over that website. I basically was informed that I have a medical condition called multiple sclerosis when I was in college. I'm a professional fiddle player, but I wasn't able to do that because it's kind of hard to do that when your hands don't work like they're supposed to. So, it was a kind of a long path toward discovering some way of making money that wasn't reliant upon my physiology to the extent that music would have been. And I kind of, through zigging and zagging through this rationale, I ended up eventually in real estate and, bought a few single families first, figured out I didn't like it, went on to small multifamily, syndicate large apartments today with my partner, Sam Grooms in Phoenix. And that's kind of my story.
Yeah. Hey, thanks, Ben. So I remember you were in Ohio and you moved to Phoenix. What is the reason for that transition?
Well, there are many reasons. Like everything in life, I think there are synergies that need to take place in order for things to really work and gel and work properly. For one thing is, I'm 43 years old. I was 40 years old at the time we relocated. My mentor, who is no longer with me, once upon a time told me, whatever you're going to do it by the age of 40. If you don't do it by the age of 40, you're not going to do it in your life. It's a lot easier to keep the ball rolling that's already going than it is to start the ball rolling at the age of 40. midlife, basically. So that was one kind of driving force, is that I felt like Ohio wasn't the place where I wanted to be. But, the driving force for that timing happening the way that it did was really, I was cognizant of my age, and I just wanted to offer myself and my family a good opportunity to start in a better life. That's one thing. Second thing is, I wanted better weather. I wanted blue skies, palm trees. I wanted low property taxes. I wanted good business environment. I wanted a lot of growth. If I never see snow in my life, it's going to be too soon. I'm completely done with snow. I wanted educational opportunities for my children that I simply wasn't able to attain where we were in Ohio. All of those things just kind of synergized together, and we moved. And so far, everything's working out absolutely beautifully. My kids are having fabulous educational opportunities. My wife is being very successful real estate agent, makes a lot of money. I am syndicating buildings that it's not something I could do in Ohio just because I wouldn't allow myself. When we talk about the underwriting, we can touch on why I wouldn't do it in Ohio or Midwest in general, my job is a function of sitting down by my pool and working my way through some spreadsheets and making some offers. And my life is a beautiful thing right now. So that's how and why we ended up in Phoenix.
Yeah. Let's talk about markets in a short while. So once you moved to Phoenix, I think you met Sam here and you guys started a partnership. My first question is, why do you want to partner up? And second is, how did you choose the partner, or how did you choose Sam, and what are the skills that you guys see that was complementing?
Sure. Well, first of all, the reason I want to be in Phoenix is because I want to be in a growth market. We buy only in Phoenix because it is a very, very serious growth market. And I happen to be very bullish on it and see quite a bit of runway still. Now, for instance, we took a look at Texas, because Texas, everybody likes Texas. But Texas was a market that started recovering like 12 years ago. So it is a very seasoned recovery at this point. There are other places, Phoenix among them, that is a younger cycle still. So I feel because of that, and a lot of other, be it income growth, rent growth, occupancies, a lot of other metrics are just looking better to me in Phoenix than in a lot of other markets. So that's why in Phoenix. The way we met is I was putting a deal together that didn't materialize. It fell apart, but Sam was going to be one of the investors as a limited partner in that deal. It was also a Reg D. And after the fact, after the thing fell apart, well, actually before the thing fell apart, he called my attention to the fact that I had a mistake in my underwriting. It was a very serious mistake, but it was an oversight on my part. And nobody finds mistakes in my underwriting. So that's a double take. And I'm like, who the hell is this guy? And how is it that, so I started looking into him. And the thing about him was he took the offering memorandum and he built the spreadsheets to reverse engineer my offering memorandum. And he found an inconsistency that I had missed. And I was just like, wow. So we had lunch. And when that deal didn't materialize, the two of us just kind of got together. He's a CPA with SEC reporting background. So he obviously has a lot of strengths that are complementary and skills that are complementary to mine. He didn't have operational experience, but he had a lot of bookkeeping and accounting and, paperwork wise, corporate level, institutional level experience. So, and he's obviously a very strong underwriter because, spreadsheets is like, his bloodline. So that worked, and that's why it worked. And the main reason it worked is because I like him a lot and I trust him. I don't have to worry about him stabbing me in the back. I would be amazed if that ever happened, and I don't believe it will ever. He's just a good person. So that's how that worked. So that's why we're in Phoenix, kind of the high level, tips of the trees, we like the market. And that's why we're together, because we have a very complementary skill set.
Good. So let's go down into the, a little more details into the deals that you guys do, right? So you have told me why Phoenix. So at a high level, Phoenix did go through a huge upswing and a downswing, right? When on the previous market cycle or market correction in 2008. So aren't you worried about that?
No, because Phoenix today is a different market from Phoenix 10 years ago. So Phoenix 10 years ago, was very heavily reliant on construction. A lot of the GDP in the state, and Phoenix in particular, was all about construction. Construction is like 10% of our economy today. We have a very diversified economy, meaning tech, banking, healthcare are the three kind of big industries. They're very well diversified. So additionally, the population growth that we experienced in Phoenix prior to the last cycle was all driven by snowbird housing. There was a lot of housing being built for people from Midwest, from Canada. Well, what happens when the economy crashes is these people lose nothing but just dropping the bag and making themselves scarce. So we had a lot of foreclosures because of that. The dynamics are completely different now because the population growth, while we still have people coming in, snowbirds, but we have a lot more true retirement. So this isn't a second home. It's actually a first home for a lot of people that are relocating here. We also still have snowbirds, but by and large, our population growth is driven by the economic growth. We're located in a place where you have California over here, Texas over there, and Mexico over here, top top 20 economies in the world, and we're within a day's drive. So it's a good place to be in terms of, commerce and trade and all of that. So, and then there's little things like, listen, 20 years ago, the HVAC units couldn't even keep up with 115 degree weather. And today it's just really a non-issue at all, right? So life in Phoenix has become more comfortable. The infrastructure is very new because the whole place is new. The property taxes are extremely low as compared to the Midwest or Texas. The regulatory environment is very friendly to business. And, as California experiences what it experiences, we are certainly benefiting with tech coming out of California. And we are one of the places that they're going, Seattle being another one, Texas being another one. But they're definitely coming here. So the economy is very much more diversified than it was prior to the last crash. And then, so that's kind of the big picture view of why I would answer, no, I'm not. I mean, I'm always concerned. People ask me, what are you afraid of? I'm afraid of everything. But you have to be logical about how you kind of respond to things and look at facts. And the facts are that nationwide, last I read, average apartment rent stands at $1,470 per month. In Phoenix, we're at $1,070. Maricopa County, which encompasses all of Phoenix and the surrounding MSA, is the number one growth county in the entire country. Phoenix is the number 2 growth city in the entire country. We now have population of 5 million. So we're number 5 largest city in the country. And with the proper regulatory environment, the low taxes on property, all of those things, insurance costs are lower because we don't have hurricanes. We don't have fires. We don't have all the nonsense, right? We don't have the freezing pipes in the middle of the winter. We don't have any of that stuff. So there's a lot of positives. So the question people are asking is, hey, here's this growth market. Our rent growth in 2018 clipped at 8.2%.
Wow, that's huge.
Depending on, well, that's because we're at 1070 And nationwide, you're at 1470. There's a 25% delta in the highest growth market in the country. So you are asking yourself, why? Basically, you're saying, why would an average rent in like Cincinnati, Ohio, cost more than it does in Phoenix, which has the good weather, all the growth, and all of the income growth, and all of the job growth, and everything, and the population growth? So that's why the investors are asking themselves, can Phoenix organically catch up to the national averages? Like, forget surpassing the averages. Can we catch up to the national? And if you say yes, because you see what's happening economically, if you say yes, then if you deploy your capital at 5 cap and you just sit on it until that process kind of happens, on your basis, you're at 6.5 cap 3 or 4 years later without having to do any value add. So this is why the cap rates are so compressed in Phoenix, is because people are just making a play on the fact that the Phoenix is undervalued for the type of economic, prowess that is currently, taking place in Phoenix. It's just undervalued. Rents are undervalued. Property is expensive relative to the rents, but if you consider the prospects of rents going up, if you look at, Marcus and Millichap, they're predicting this year at 6.2%. If you look at Colliers, they're at over 7%. So again, depending on who you look at, I think we're going to be closer to 7%, just because we have such delta and because of what I am personally experiencing in this environment. Okay. We just have a lot of upside. The ceiling is very high. Juxtapose this against Austin, which is stalling out at this point. It's a very seasoned market. The rent growth is stalling out. The vacancies are taking up. So it's Texas. So can it continue being Texas for the next 5 years? For all I know, yes. But given the choice to be in a younger cycle such as Phoenix, or to be in a season cycle but in a very strong location historically that's proven itself, I don't know. That's where people kind of make their bed, I guess, and make the bets. I like Phoenix. I'm bullish on Phoenix, and I'm not even looking to any place else, because if you can be in Phoenix, why would you look at anything?
Yeah, that's exactly my point as well. I'm in Texas, and I'd rather invest in my backyard, even though it's competitive over here, right? So, but in your backyard, you have a lot of control. You can go drive by and see it compared to somewhere else. I mean, real estate is so localized. It's important for you to know your own backyard, right? So coming back to the sub-market, right? How do you choose the sub-market on Phoenix? Is there a specific preference for sub-market compared to the deals itself?
I don't really worry about sub-markets because I don't buy buildings. I buy stories. So if there's a good story for a specific building, because all it is that you are looking for a delta. The money is always in the delta. So if you can purchase the building here, but the story suggests that the building, the future valuation is going to be recognized here, then that's the delta I'm paying for. That's what I'm buying. I'm not actually buying the cash flow. I'm not a cash flow investor when I syndicate these things. Cash flow is there as a pathway to generating wealth and generating equity. But that's it. There's not cash flow investments, because you can't drive the IRR on cash flow. It's discounted too much over time. You need the appreciation. The appreciation is in the delta, and the delta is in the story. So, we bought the Canyon 35, and that's half a mile away from a university. A Grand Canyon University that grew from 2,000 students to 20,000 students in 10 years, received public status accreditation, is investing $1 billion into their campus, gentrifying everything around them, of course, as usually happens with universities when they grow. And they're going to be at 30,000 students within the next 5 years. So I'm buying a building half a mile away. That's my story there. I buy another one over here that is in the middle of a huge redevelopment and rejuvenation by the city. The city is deploying a lot of capital. There's a lot of Class A infrastructure coming in, both in terms of retail and office space and everything else. So I buy this Class C building. It's surrounded by all this Class A stuff. It's uniquely positioned to be able to compete with Class A on finishing textures when I'm done remodeling, but at a much lower basis, so my rents don't have to be anywhere near where the Class A rents are. And so it's a story. It's always a story. What is happening economically that is going to give my building a desirability that is uncommon at the basis that I will be at? So, the submarket itself doesn't really, I guess there are places you wouldn't want to go, but we wouldn't look in those places because nothing is happening in those places. The whole point of where we want to buy buildings is because good things are happening in that location. That's why we want to buy a building there, especially in this season cycle.
Yeah. So what you're saying is there are places that you wouldn't even look at it, right? It's basically sniffed as, this area, I'm not looking at it. But
well, there's area and there's a building. I get these emails by, 100 a week and vast majority of them go into trash before they're even opened. And of those open, vast majority go into trash. And that's got to do with age, quality, construction, features, because you can put lipstick on a pig, it's still a pig. You can put a gold-plated toilet in a pig, it's still a pig because of what it is, where it is. It's going to attract the audience that it's going to attract. There's nothing you can do with it. And I don't want those buildings like that. I want a building which inherently, the bones of it, are just something that's not coming through in a recognizable way, shape, and form for the marketplace. But if I put some money and energy into this asset, I can bring back what it already is. I'm not trying to take a pig and make it into a unicorn. I'm trying to make a unicorn that's been completely messed up and it looks like a pig, but it's a unicorn. It's not a pig. I just have to resculpt it, redo it. I have to clean it up, improve it. And then the market will see it for what it is, which is a unicorn. That's what I want. And that's a function of both location and the asset itself.
Yeah. So I think what you're describing is what I would describe as built-in upside. So I look for deals where I know today I can go and just improve on it, either by capital or reducing expenses and just realize that upside that has been hidden inside that building. And that's a lot of it in multifamily, right? And it's just, you have to find that kind of deal. It's hard to find that kind of deal, but that is the real deal, right? Compared to buying.
Well, that's right. And it's a needle in a haystack. And in fact, if you are not almost practically doubling your NOI in the first 3 years, you're not buying the right kind of building because you can't, that's what it takes. In my experience is almost doubling the NOI.
Correct.
In 3 years.
Yep. So let's go to underwriting. So I'm sure. So where are you getting your deals? Are you getting from brokers?
Brokers.
How are you?
They're off market.
Okay.
But they're brought to me by brokers.
So why do they come to you?
Because I close.
Okay. No, there must be, usually, I realize, brokers do a lot of off market, but they look for qualified buyers, right? So especially people who have done deals with them, right? So maybe.
Right. That's why. And even if I didn't do a deal with this broker, I don't know. I don't want to drop names because I don't want to, but the national brokers, one of them reached out to me yesterday because even before we closed last week on the last one, somehow everybody already knows that we're going to close on it. And so these guys start coming out of the woodwork. Well, this schmuck emails me. He calls me twice in a row. He says, "Oh yeah, I got an off-market property for you." Okay. I say, "Okay, go ahead and email me the non-disclosure agreement. I will sign it and email me the stuff." Well, he emails this property to me. Well, another broker already showed it to me 2 months ago.
Yeah.
It did not require any kind of non-disclosure. It was a pig. It was the very thing that we're describing the don't do. It's the wrong shape. It's the wrong footprint. It's the wrong mechanical layout. It's the wrong age. It's the wrong location. It's the wrong everything, right? And these guys call you and they say, well, you can get it for $75 per door. Well, I'm like, I would rather pay $100 a door, but get quality that's going to be worth $180 when I'm done with it, rather than paying $75 per door, because guess what? Whatever money I put into it, it's still going to be worth $75,000 per door when I'm done, because the market has decided this is a pig. It's worth $75 per door. That's it. There's nothing you're going to do to move that hurdle. And so you get a lot of that, but you also get some serious brokers who are usually, like, the biggest broker in Phoenix is not a national broker. They're a local, but they're the biggest by volume. They do the most deals in the apartment space. And those guys bring me deals that are deals. And they're not the only ones. Other people do as well. We've tried to go after some deals with other brokers. We came really close. We weren't able to, for one reason or another, to execute those deals. Somebody else got it, whatever. But sometimes brokers have deals, and they're off-market deals. The question of what's it going to take to get those deals, I just don't have an answer. You just, it's all about relationships. You're going to have to convince somebody that you are worth having a conversation with and that you have a good chance of executing. Obviously, it gets easier immediately after the first deal closes. Immediately.
Right. Yeah, just because of credibility, right? So
That's it.
let's say today a broker sending you an OM, right? So, some random brokers, and he said this is a deal, and it's not a pick, right? So there's something more I need to do my secondary inspection here, or my secondary underwriting here, right? So how would you go about underwriting the deal?
Well, so the first and most important thing in the underwriting process is to place after renovated rents. Because if you mess that up, everything else just doesn't matter. Where most of the money is knowing down to the dollar and the cent where those rents are going to be after you are done fixing the community and fixing the unit. So that's the first thing I do, is like, if it's well located, it's the correct year, it's the correct HVAC, it's the correct roof, it's the correct XYZ, which I can tell just by looking at this thing. It's in the correct sub-market where I know I would want to be. The next step in the process is just to put it through the underwriting. That begins with placing rents, understanding what the rents are going to be.
So how do you place rents? I mean, how do you do the rent comps?
For me, if a broker is sending me something like this, what is accompanying it is some kind of Yardi report or metrics or something, some kind of report on the sub-market, which is going to give me the comps. Now, those reports aren't correct, but they're probably within 20% margin correct. They're real looking, and in the market that's trending 7-8% per year, obviously those metrics will be off. But that's a place, first of all, I know what the rents are in Phoenix MSA for the class of asset I want to buy in the kind of location I want to buy. To validate myself, I then look at that report. Okay. Now, the underwriting, for the most part, is an automated process because we kind of know what the OPEX is. There's really very little magic to how much it costs to run these buildings. There are a lot of reports that study and track by the state, by the locality, by the city, what the operating costs are running. And so we underwrite to the averages, and we have our own trailing numbers, which we use in the underwriting. So we do massage those for every deal, depending on the size and the complexity of mechanicals and things like that. R&M is going to vary, and certain services are going to be required here, they're not required there, contract services, things like that. But by and large, I know that on the operating side, I'm going to be somewhere between $4,200 per door and $4,600 per door. $4,600 per door is on a smaller asset, maybe 100, maybe 95. $4,200 per door is 120. 140 is going to tick up because now I need more payroll. And so you know what those dynamics look like. So we can kind of, where both Sam and I are starting with numbers filled in. Okay. Because we know where those ranges are. And this is just for the first path, right? Okay. First time through. Now, if the first time through, I mean, like it takes me
and just before, let me quickly interrupt you. So how many % of operational income is that? 4,200 to 46? Do you look at percentage as well?
Yeah, that's the beauty of Phoenix. You're talking about being under 40% on a stabilized basis.
Under 40? That's really good.
35 and 40%. Well, this is the thing about Phoenix, I have to tell you, that the operating cost, like I studied the operating costs all over the nation. I will tell you that in Texas, it's over $6,000 per door because the property taxes are so high.
Correct. Okay?
Yep. In Cincinnati, Ohio, it's over $6,000 per door. Over there, it's for a different reason. It's all hilly. The buildings are all older. There's boilers involved. There's flat roofs involved. Pipes freeze all the time, and buildings sit at the bottom of where water flows, and you just got R&M and contract nightmare. In Phoenix, because property taxes are so low, because the insurance is so low, and because, frankly, a lot of things are easier in Phoenix because of the weather. It never snows, such things. The operating costs, if you look at the national reports that indicate per city, you will see that Phoenix is in the mid $4,000 per door. Now, as a relationship to the rent, though, that's very low because even though Phoenix is lower than national average, still, when you're running at $4,500 plus or minus, like we just purchased last week. So my underwriting for that asset is right around $4,500, $4,600 per door on the OpEx. But dude, we're running, let me calculate it. We're running Silver Tree, which is 98 units at about $34,000 per month.
That's awesome.
$4,000 per month divided by 98 times 12. Yeah, 4163, under $4,200 per door. That's OpEx. Now, obviously, you're going to have CapEx that you're, exchanging blinds, fixing.
Correct.
It's not part of the scope. It's just part of the turn on each unit. But, with my underwriting 4,600, I really don't think we're going to need it. In fact, we can run 117 unit on the same payroll that we run 98 unit. So theoretically, that number, that OpEx number should be closer to 4,000. Okay. So in terms of relationship to the top line, you've got very, very pleasant circumstance in Phoenix that you can't achieve in a lot of other places.
Yeah, I think your rent is high compared to Texas market. I mean, forget about Austin. Austin is a different market, right? But if I look at my San Antonio deals, my expenses are $4,500 to $4,600, but my rent's also lower. So end up my expense ratio is like almost 50%. But what you're describing to me in Phoenix looks like mobile home parks expense ratio, because I know their mobile home parks expense ratio is like around 35 to 40%. So if you can run at 40%, that's a really good market because your income is high and your expenses are low.
I'm going to look at it right now.
Okay.
And
that's really good numbers in terms of percentage into relationship.
Yeah. So in the first year, I'm projecting 49%. In the second year, 39%. In the third year, 35%. And then it ticks up a little bit because I'm using a little more R&M as my remodel gets seasoned and it gets older. A little more money for turns, a little more money for R&M, those kind of things. So, but yeah, we're staying underneath 40%.
That's very interesting. So is that what you're consistently seeing even on the broker O&Ms?
The broker OMs are going to be even lower. Okay. The broker OMs on deal like this come with like $3,900 of operating cost.
Okay.
38, 39, which is unrealistic. If you go to the bank, try to get financed on that, it's not possible. So for the bankers, you have to show underwriting in the mid 4,000s. You just do, But I have to say that in Texas, if you are showing $4,500, $4,600 per door, that's really good. The stuff that I underwrite is just a lot higher than that.
Yeah, we have our own operation. We are vertically integrated, right? So we're able to run it much more leaner, right? And the question I have for you on the property taxes, how do you underwrite property taxes in Phoenix? I mean, do you have the same, or do you increase a bit? I mean, because I know in Texas we always push up to 100%.
In Phoenix, there's regulations in place that were passed about 3-4 years ago. Okay. Whereby the municipality is not allowed to raise property taxes any more than 5% per year. This applies to the assessed value and the actual tax bill. So it's regulation on the books. So the tax underwriting in Phoenix is the simplest thing ever because you don't have to guess. You don't have to take a basket of properties. You have to do nothing. You're just, you are not going to go up any more than 5%. So in my underwriting, I use 5% a year, which is worst case scenario, done. Now, there are caveats. If you are going to put another building on the property and trigger reassessment, that triggers all kinds of circus. We don't do that. I won't buy anything that requires me to move exterior walls to do that kind of stuff.
So what you're saying is, even though the property has changed hand, the maximum they can go is 5%.
Sales.
Wow, that's awesome.
This is what I'm telling you about regulatory environment being conducive to doing business. Yeah. They don't chase sales. And everybody says in Texas, just buy the LLC. They will never know what you pay. They're not stupid. They're going to look at the loan. They're going to apply the LTV in reverse. They're going to guess at what you paid, and they're going to assess your taxes up to wazoo. Yeah, I mean, the gurus out there, it's laughable. It's hilarious, And Texas has always scared me because of that, because I can't underwrite taxes. The same is true in the Midwest, the Indianapolis. I remember I paid an attorney. We were looking at a deal in Indianapolis. Well, listen, it had in-place property taxes of about $60,000. But if I were to follow the letter of the law, I was getting 3 times that much. Okay, which obviously is going to penalize the building. And obviously the broker wasn't showing that much increase. So I paid an attorney to speak to an attorney. Even they can't tell you because, they're not chasing sales, but they're going to take a basket of properties and like location. They're going to kind of synergize all of that data, and they're going to increase everybody by the same amount. But who knows what kind of basket of properties it is? Yeah. Which properties make it into the basket? When were they sold? So the only thing you can do there is look at trailing billings and back into the probable increases, but it's not scientific. It's not, you can't, there's over here, no more than 5%, boom. And so far, that's exactly what it's been, 5% per year.
That's awesome. I mean, in Texas, it's just so crazy in terms of property taxes. You do not know what to underwrite. So I always underwrite to 100% increase, just to be safe in terms of underwriting. But it's also a problem because, you can buy a deal which is like 24 years, not changed hand, and now you have to underwrite 100%, which can be huge, right? And it's a mismanaged expectation between buyer and seller because, seller is going to say, hey, this is what I'm running, and buyer is going to say, hey, I have to underwrite completely different, right? And it's just hard to do business. But
that's right.
That's very interesting on how they do it in Phoenix. How do you underwrite like miscellaneous income in terms of what after you take over?
Well, the next step in the process. So once we put it through the underwriting and, it looks good, Sam and I drive out to the property. We'll look at the property. We'll like it. We go home. We really dial in our underwriting. What do we think the rents are going to be? What do we think the expenses are going to be? If it still looks like it's a deal, the next thing that happens is we send it over to our property management company with 20,000 units under management and obviously all kinds of access to all kinds of trailing data that we don't have. Okay. So the ultimate decision on where the rents are going to be, where the OPEX is going to be, all form of it, that ultimately is all approved or okayed by them or adjusted whichever way they see fit. The RUBS, the utility income, is a very simple proposition. I mean, I underwrite 90% recovery. And sometimes we can do better, but I underwrite 90% recovery. Whether you do it, whatever methodology you use, third-party RUBS or whatever, RPM likes to use third-party because of legal absolvence, so to speak. Okay, they like to offset the risk in that way. And as of late, past few years, regulatorily, it has become more and more difficult. But I shoot for 90% recovery of the property's utility bills, and other income is just purely specific to the property. What I'll tell you on the other income is that when we're taking, I have to back into that conversation a little bit. Okay. What's different about Phoenix than it is about most other places, including Texas, is that value add means something very different here. Usually, when we do value add, we're looking for a mismanaged apartment, quote unquote. Well, mismanaged usually manifests itself in vacancy. So a big part of our value add is to put proper management infrastructure in place and to capitalize on that vacancy and to bring it from 12%, 14% to 6%, which is, according to the market, that's where you're supposed to be, right? So you do what you got to do to fill those units. The issue with Phoenix is that vacancy pretty well doesn't exist. It's such a high growth market, and there's such a lack of demand of $8,000 to $1,000 units, $800 to $1,000. There's just such a lack because you can't afford to build it. So there's such a lack of that demand that asset class is basically full. Even like the most poorly run properties are operating at full occupancy.
So you're saying lack of supply, right? Not lack of demand.
So there's lack of supply. I'm sorry.
Okay, got it.
There's a lot of demand. There's a lot of population growth, but there's a lack of supply. Specifically in that price point, $8,000 to $1,200, because the basis of building it, call it $200, $225 a square foot, you got to get higher rents than that. And so, if for the huge section of population that needs those $800 to $1,200 rents, there's a lack of supply on that. So what is value add? Well, value add is $300 per door in this case. Let me walk you backwards. We just closed on 117 unit. The physical vacancy on an annualized basis in that submarket is 2.6%. Wow. 2.6%. Now, can I underwrite that? No. I have to underwrite 6% plus economic vacancy. But just speaking about physical vacancy, I have to underwrite 6%. I am penalizing my underwrite because, the seller is operating at 2.4. When we took over, there's zero vacancy. There's one downed unit and zero vacancy. Okay.
What economic occupancy, how much do you underwrite that?
I underwrite economic occupancy 9%.
Okay.
Somewhere between 9 and 10. But on this deal, I did 9%. And so 5 to 6 of it is physical vacancy, and 3 to 4 of it is the rest of the economic occupancy, economic vacancy. But what I'm saying is that if the building is operating at zero vacancy and the submarket is operating at 2.6% vacancy, and I am underwriting 6% vacancy, I am penalizing my underwriting 3.4%. So I need the first amount of value add just to compensate that so I can break even. And then I need a whole bunch more value add so I can actually create the delta so we can do create enough profit margin for the IRR to work. Okay. So what this ends up looking like is value add in Phoenix is $300 per door.
How did you come up with $300 a door? I mean,
it's just what it takes. In order for me to back into the IRR to the partners that is going to be attractive for people to invest, what it seems to me I need, and it seems to be across the board for every deal that we do, what it's requiring is $300 per door value add. So we're buying these deals that have talk about a unicorn, $300 per door of value add, only because we don't have vacancy. In most places, like if you have physical vacancy of 10% that you can fill, then maybe you just throw some lipstick on the pig and make it another $75 a door, paint the cabinets, do some resurface countertops, do something like that, get another $75 of value add, and you're good. Your IRR works because there was vacancy in place that you were able to fill. We don't have any vacancy. So we actually have to do the heavy lifting to recapture the loss to lease and to get the renovation bump. And cumulatively, what it's taking us is $300 per door. Anything less than that, we can't get the margins that we need.
So my understanding, when you talk about $300 a door, I mean, when I underwrite my deals, the $300 a door is basically just the rent. But you are saying the $300...
No. It's cumulative between LTL. So about 175 of it.
Okay.
The reason the occupancy is at zero is because obviously the rents are too low.
Okay, got it.
You should never have zero occupancy. If you are staying with the market and you're pushing your rent, you should never have zero occupancy. So the fact that the occupancy is zero is because the rents are too low. So on day one, we're walking in and we're raising rents $150 to $175 on the renewals. Okay. And the rest of it is a bump due to the renovation. So cumulatively,
you're going to
be able to take... So you have their stated rent. Then you have their actual payroll, rent roll, which there's a bunch of loss to lease between the rent roll that they're actually getting and their stated rent. Now we're coming in, we're saying, no, our classic rent is going to be this right here. So now we're going from their LTL all the way to our classic rent. And then on top of it, we're saying, but after we remodel, there's another piece of it that gets tacked onto the end. Cumulatively, that entire process in Phoenix MSA, in Class C value add property, in my experience, $300 per door plus or minus is what's required.
That's awesome. And what is the total IRR that you look at for? I
look to deliver to partners something in the mid 14 to 15. If I hit 14% IRR on a 10-year hold, and I always underwrite 10-year hold. I don't want to sit there for 10 years, but especially because we're late in the cycle, I underwrite a 10-year hold. So on a 5-year hold, it ends up somewhere around 17. 17 plus.
Got it.
And of course, if we can exit sooner, then those numbers get silly.
Correct. So let's talk about once you close on the property, right? So you underwrite everything on a paper and it all looks good, right? So now you close on the property, right? So now you have a task of pushing up that rent. How do you go about pushing up that rent?
So I don't do it. My PM does it.
But you're going to hold the strategy to it, right? I mean, are you going to tell them how to do it? Or?
Correct. So we had a meeting on the day after we closed at the property. We had a meeting. At the meeting was the property manager that's on site, the regional, and Sam and myself.
Okay.
And what we discussed is that because in the next 3 months, there's only about 3 or 4 leases coming up for renewal each month. On a 117 unit property. Right now, we don't have a classic rent. As leases come up, you can either stay in the unit as is and pay us our renovated pricing, or you're welcome to leave and then we'll renovate the unit and somebody else will move in and pay the renovated pricing. because the business plan calls for so much renovated pricing to be entering the payroll each and every month. So because we don't have enough vacancy coming up, we're basically not renewing leases and we're not putting in place. I mean, it's unreasonable to ask people to pay the rent as if the apartment has stainless steel and granite, underhung, but I don't care. If they leave, they're entitled to leave, and they should leave. The fact of it is that they're probably not going to find anything better to go anyhow. At the end of the day, as long as I'm getting the rent, I don't care if I remodeled it or not, because as long as I'm getting my rent projections, I'm in good shape.
Yeah.
But I am prepared for a certain number of people to be, I don't want to say forced out, but they're welcome to stay as long as they pay our rent.
Yeah. So your rent increase like 300, there's two components to it. One is just loss to lease, even without renovation. And on top of it, there's a renovated unit. So you can do two ways, right? One is you can just not renovate and just go halfway up there. But I think what you're saying is you rather, because of your business plan, calling it.
We don't want to do that for one very specific reason. This has been the model over the past 5 years. The model is, $4,500 of renovation buys you painted cabinets, refaced cabinets, resurfaced countertops, maybe upgraded appliances, not stainless steel, maybe black, some fixtures, some flooring, and some paint. That's what $4,500 buys you. We're spending $7,500 per door, and that gets us granite. It gets us underhung sinks. It gets us stainless steel appliances. It gets us nicer flooring, paint, all the rest of that, okay? So the reason we're doing that is not so much that we couldn't make our numbers work. It's driven by the cycle. We are late in the cycle. And when the cycle changes, I want to have the best product in the submarket at that price point. When everybody starts taking on loss to lease, when everybody starts taking on concessions, when everybody starts the race to the bottom, my thing is I'm paying for my staying power at that point, but I'm paying for it now. I'm doing the rehab now. So we're accomplishing two things with that. Number one, obviously, we're repositioning the property. We're repositioning the tenant base. We're creating a more manageable situation. And number two, the product that we end up with 3 years down the road has a lot more staying power than another kind of product that wasn't as renovated.
Yeah, especially if you can afford that much of money right now and make the deal work, right? You can always invest in that product right now, right? That's
so these are syndicated deals. So we collect the money up front. There's nothing worse than coming to your partners and saying, hey, we need $1,000 more. So we collect all the money up front and we deploy it right away and we reposition the property right away. And, 18 months down the road, we arrive at a situation where we start having an exit. Now, our buyer may look very different 18 months down the road from the buyer 3 years, from the buyer 5 years, from the buyer 7 years down the road. But we have a compelling story to tell at that point in time. We start working on that story right away on day one. But yes, our renovations are good renovations. We replace the cabinets. We replace, they're getting new kitchens. They're getting new bathrooms. They're getting these are seriously upgraded units when we're done with them. Now, our pricing is phenomenal. We're getting stuff done for $7,500, $8,000 on the interior that other people are complaining costing them $13,000 to do, and they're not wrong. It's one of the benefits of having a PM with 20,000 units on a mat. There's a pricing power that comes with that. Both in terms of subcontracting and in terms of materials, how they source their materials. So, but that's we could work our IRR having deployed half the funds, just get lower rents, but for less money. We could work it. There's just the other piece of it, which is that 3 years from now, when the market does cycle potentially, what do I want to own at that point?
You want to own the best product, right?
I want to own the best quality that people can buy for that amount of money.
Got it. So what do you do? I mean, we have a few more minutes to go. Very quickly, what do you do in terms of asset management? How do you do? Is there any systems that you put in to manage the assets?
Yeah, we use IMS.
Okay.
And
IMS is on the investor side, right? I'm talking more about the property side, right? Looking at property performance.
Oh, they use the Yardi.
Yardi, okay.
Yeah. The PM uses Yardi, and then we get reporting weekly from on-site in terms of it'll have things like to-date collections, it'll have vacancies, it'll have remodeling information, like how many units are remodeled, how many units are pre-leased, how many units are leased, all that stuff. Vacancy, it'll have delinquency, it'll have promise to pay, all of that stuff. So it's a one-page report that kind of gives us a bird's eye view on the whole thing. And then once a month, at the end of the month, we get a packet this thick. I mean, I've never tried to print it off, but I'm sure if I did, it'd be this thick from the PM. And that includes everything trailing everything.
Yeah. So one question that I ask in all my podcast guests is, what is the most valuable value add that you see in your experience?
I think the finishing textures inside of the units. I think that people are willing to forgive you. And we do things like upgrade laundry rooms. We build out, we don't build a separate building, but like if our laundry room is this big and it only needs to be this big, we're going to put a wall here and make a gym over here and the laundry room over here, things like that we do. And, but people are willing to forgive you so much if you create an interior that looks good and functions well. I mean, I don't care what you do on the exterior. If the inside of the unit is not great, it's just going to be difficult to drive rents. Now, once the inside of the unit is great, there's a bunch of other things you need. You can't have an ugly looking laundry room. You can't have no amenities. You can't have a shitty looking office. You have to, it's a complete packaging thing. But I don't know. I mean, I guess my perspective is different on it. I don't nickel and dime my renovations because I'll never get the rents because of what we talked about. I don't want a hodgepodge unit, painted cabinets that are, 30 years old and resurfaced countertops. I just don't want to be left standing holding that bag. If I have to be in this property for another 5 or 7 years, for example, I don't want to be holding that bag for that long. So I've never really went through and said, okay, how much is a countertop worth? How much are new cabinets worth? I mean, because we're doing all of it. I have my scope. I know what's included. And at this point, it's just the easiest thing because we dialed it in. We know where everything is coming from. The PM just orders everything. And we know how much it costs. If this kitchen is a little bit bigger, it's got one more extra cabinet. Well, hell, pricing goes up by $135. It's like it's not difficult at this point to know what the remodel is going to cost.
Yeah,
but
got it.
We do it all.
Okay, so you primarily focus all of it inside the interiors.
Yeah.
So a lot of people are trying to start in multifamily nowadays. I mean, multifamily is a buzzword right now, right? I mean, the economy is doing very well. Everything is so good. What would you advise to a newbie who's trying to get started in multifamily? That's a long sigh.
I don't know. Because economy is doing really well. That means the competition is very stiff. The thing is, you really got to know what you're doing. This isn't a good time for newbies, because the economy is doing very well, and it'll probably continue doing well at some point. It'll go down, and it won't do so well. And the decisions you make today could hurt you tomorrow. And if you are just starting out and you're a newbie and you're looking at, I can't imagine how you do large multifamily and you haven't bought some fourplexes before and some sixplexes and haven't internalized all that stuff. you're better off just investing money in somebody else's deal. Honestly, I feel at this point, because the stakes are too high. I am buying at 4.5 cap. You can't make money at 4.5 cap. You can only lose money at 4.5 cap, which is why I buy a needle in a haystack, very specific asset. If you are a newbie, what the hell do you know to be able to do anything of what I do?
Correct. There's so much of details in renovation, finding deals, underwriting deals, so much, so much skills involved, right? It's not like anybody can jump in and do it right now, right? So,
which is why we have this conversation, which, should be attractive to more seasoned people, to people like us, people that already have that ball rolling and they're maybe trying to break out to the next level or something. If you're talking to me about newbies, this isn't a conversation they should even listen to, because half of it they wouldn't understand.
They wouldn't understand. Yeah, you have to do it to really appreciate it, right? At least you should have flipped one property, or should have done rental.
Have a 10. I mean, listen, underwriting is expressing with numbers the behavior of people and the interaction of people and property. That's all it is. If you've never dealt with a tenant once in your life, how do you know what those dynamics even look like?
Correct. Yeah, I've seen a lot of newbies right now, immediately, they're buying 100 units, 200 units. Market is so good right now, right? You're relying on property management. There's a lot of wind on your back, right? The appreciation itself carries you up, but that's not going to go. That's not going to be happening all the time. Everybody's a champ in a bull market, right?
Right.
So yeah, we started in a single family. We did so many single families. We learned through the hard way. Even contractor management, it's a skill by itself.
Yeah.
Right, the whole timeline management. So that's a really good advice, Ben. And is there any other things that you want to share to our audience that you have never shared in any other podcasts?
Yeah, fat chance of that. I think I've shared everything about me in every other podcast. In fact, I'm about to launch my own podcast to share the rest of it. And I'm not sure what the hell I'm going to talk about on my podcast, because I've already said everything on everybody else's podcast.
Yeah, we already listened to Ben in somewhere else.
But it's going to be very, very high level. And I'm not going to make those excuses. I'm like, if you're a newbie, you probably shouldn't listen to this, because we're going to be talking about stuff that you have no idea about.
Correct.
A friend of mine who's no longer with me has always said to me, stumbling blocks and stepping stones look a lot alike from a distance. So if you are a newbie, what I am telling you is be really sure that you know the difference between a stumbling block and a stepping stone before you step. So many of you guys are stepping first and then figuring out if it was a stumbling block or a stepping stone. And that could be a very painful process. So, I don't know, education,
yeah. Go through the hard work of going with smaller deals first. That's what I would say, just learn the ropes.
I agree.
And then learn the whole thing, make sure that you can do it. It's not, syndication, turning around properties is not for everybody. That's how I would say. I mean, there are a lot of people who can do it, but start small and grow and learn the skills.
Yeah, right? I very much disagree with the gurus who say, hey, it's just as easy to buy 100 as it is to buy 10. This is true. It is just as easy to buy 100 when you know what you are doing. But the way you get to know what you're doing is by having bought the 4-plex and the 6-plex and the 10 unit. I disagree. I think it's criminal advice to send people directly into large multifamily.
Wow. Okay.
Have this be your goal. Be excited about it. Be, whatever. But you need to internalize the dynamics of the game. People act in ways that are going to shock you. And the numbers reflect that. Don't be stupid. Don't be going and saying things like, okay, here's the income. Let's just use 10% for property management and 10% for vacancy. And, dude, those things, it's just like, get a little intelligent about what you're doing. For instance, the conversation I have with people all the time, listen, in a $500 rental, if you have to replace a furnace, it costs you $2,500. In a $1,200 rental, if you have to replace a furnace, it also costs you $1,200 or $2,400. As a percentage of the top line, you see how that's a totally different figure. That's because all of the expenses in real estate are dollars. They're not percentages. We back into percentages. So James and I know what our percentages are because we've studied the dollars and we backed into the percentages. So if we ever use a percentage, it represents a dollar. What you guys newbies do a lot is you take this rent and then you divvy it up percentage-wise to this. That's just not how real estate works, and that's how you get hurt.
Correct.
Simple things like that amaze me that people don't think about and don't know. And they jump into this stuff because Marcus and Millichap says on the pro forma that this is how much percentage you need to allocate to XYZ. That's just nuts.
Absolutely. Okay, so Ben, thanks for being here. Do you want to tell our audience how to reach you?
You're not getting my personal phone number. Oh, shit. You're not getting that. James can have it, but you can't.
Sure.
But you can email me at ben@justaskbenwhy.com, or you can just go to justaskbenwhy.com and look over my website. You can email me through the website as well if you'd like. But I have a couple of different email accounts for like serious people, and then people like you just looking at me. I'm not giving out those.
All right. Hey, thanks, Ben, for being here.
Offend? I get on a podcast with one goal in mind. Offend as many people as you can, Ben, because this is your brand. It's what you do. So go for it. I think I offended a few people, didn't I?
No, I think, I like, the real numbers, right? The real details, because sometimes some gurus out there makes real estate and multifamily so easy. I mean, people have to realize people are selling education as well, right? So it's not that easy, right? There are a lot of science behind multifamily. There's a lot of hard work behind it. There's a lot of, it takes a lot of experience looking at, hundreds of underwriting numbers and trying to figure out. And of course, there's also another aspect of now I already buy it. Now I'm going through the whole real asset management stuff, and I realized, whatever I underwrote was completely different from what I'm doing asset management, right? So realizing that it takes a lot of experience as well. So it's a learnable trick, but there's also a lot of hard work involved in growing and doing the real stuff. That's what I see. So that's really good advice, Ben. So thanks for being on the show. For my audience, thanks for being here. As I said, you have a lot of things to do outside of listening to this podcast, and I really appreciate you guys being here. We hope we really delivered value to you guys. That's the reason I'm doing this podcast, to give true value to listeners and learn as much as possible before dabbling into real estate and multifamily commercial real estate. Thanks, and talk to you all soon.
Thank you.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources, by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.